You watch the green candles march higher. The momentum feels real. You enter a long position, expecting the breakout, only to watch the floor drop out and your capital disappear into a sea of red. That pattern is not an accident. The current price action pushing Bitcoin higher shows signs of technical exhaustion, and it is structured to trap retail longs. What looks like a resurgence is actually a short-term trap, the final setup before a broader, macro-driven market correction. Beneath the surface of this rally, institutional market makers are actively targeting a specific hidden liquidity level for the breakdown. By the end of this video, you will know exactly where that institutional roadmap points. Understanding this layout is the difference between getting liquidated and front-running the impending drop. Welcome to Crypto Whale Radar. On the daily timeframe, price has crossed the closely watched 75,400 golden Fibonacci ratio, coinciding with a clean vector trendline break. But this move is choppy. Momentum is low, taking significant time to push into this higher territory. This rising price action directly contrasts the volume. As price crawls upward, the volume oscillator shows a steady decline across daily and weekly timeframes. This divergence, price rising while volume falls, points to structural weakness. It suggests that the higher price levels are not being supported by new capital entering the market. In technical terms, this move displays the characteristics of a counter-trend rally. This lack of volume indicates that the aggressive institutional buy-side demand that drove previous rallies is largely absent from this move. Pushing price up on thin volume allows market makers to engineer upside liquidity. They're building a pool of buyers to sell into, rather than initiating a durable trend. To see where that liquidity is concentrated, we look at the 2-week liquidity heat map tracking over $300 million in clustered short positions. Notice the intense concentration of stops sitting strictly above the recent highs, resting between $79,800 and the $85,000 CME gap. Market makers have a mechanical incentive to sweep these highs first. Hitting that zone triggers a cascade of short liquidations, creating the artificial buying pressure needed to fill large sell orders. That engineered upward sweep creates a false breakout. It looks like a massive pump, which often traps late retail buyers into opening long positions right before the reversal. Trading these high volatility sweeps requires execution reliably under pressure. That is exactly why we trade on BigX. During engineered fakeouts, retail exchanges often suffer slippage or downtime. BingX provides the execution reliability necessary to manage risk here. You can use the link in the description to register on BingX. This unlocks platform bonuses and direct access to our trading mentorship. Identifying where this trapped upside liquidity sits allows you to plan entries alongside institutional moves, rather than acting as their exit liquidity. Once the market sweeps shorts and exhausts upside liquidity, the focus shifts to the downside. Because price has not yet swept the stops below these levels, they remain as magnetic targets for a corrective move. On the 2-hour time frame, we can map the structure of the recent higher lows. Below each of these steps sits a pocket of untapped liquidity. To find the primary target for this move, we add the anchored VWAP to our analysis. When we anchor the VWAP to the start of this pump, it extends directly through the clusters of liquidity we identified beneath the higher lows. These untapped liquidity pools and the anchored VWAP align at the $74,000 level. The daily high timeframe support level provides a third independent metric for this price zone. The convergence of these 3 distinct signals identifies $74,000 as the primary cluster for the first major downside move. This suggests a 2-part sequence, a sweep up toward $85,000 to trap longs, followed by a sharp rejection down to this $74,000 liquidity zone. When the fakeout loses momentum, this $74,000 overlap serves as the high-probability institutional target for a short trade. Navigating these cycles requires consistent data tracking. Subscribing to Crypto Whale Radar provides the risk management perspective needed for this volatility. A common narrative suggests that ETF inflows have fundamentally broken the 4-year cycle. This comparison shows how the 2026 trajectory is currently tracking the specific structural milestones established in the 2018 cycle, with the peaks aligning almost perfectly. We are currently in a midterm year, a phase of the cycle that historically involves significant price digestion. If we look at the April price action, we can see the formation of a higher low. In the 2018 midterm year, A specific 5-week counter-trend rally emerged from that exact April low. When we overlay the 2018 sequence on today's action, the geometric match is precise. Historically, these 5-week rallies have marked the terminal point of momentum before a significant breakdown. This alignment points to two specific windows of weakness: June and October. The June window has historically acted as a flush that wipes out early year gains. The October window then provides the final, durable bottom for the year before a sustained recovery begins. The data indicates that these rallies are predictable cyclical traps, placing the current market on a direct path toward a June correction. The argument for a continuous bull run often cites the S&P 500 sitting at all-time highs. This tree map shows that the equities market is being propped up by extreme concentration in the AI sector. Outside of names like Nvidia and Google, the broader market is struggling. Beyond the AI boom, the macroeconomic reality is putting pressure on global liquidity. Energy costs are surging, with Brent crude oil breaking the $120 a barrel threshold. High energy costs lead to persistent inflation, which is why we see the CPI stalling at 3.2%. These twin pressures of high inflation and surging oil costs make it likely that the Federal Reserve will maintain high interest rates for an extended period. High interest rates act as a drain on liquidity. Without expanding liquidity, risk-on assets like Bitcoin lack the fuel needed for a macro breakout. The roadmap is clear: an initial sweep toward $85,000, a technical breakdown to $74,000, and a macro plunge into the $60,000 range to clear the June cycle lows. In this midterm year, the priority is to avoid buying into low-volume pumps at historical resistance. Trading this drop requires precise risk management. To prepare for the move, click the next video on advanced stop-loss placement to ensure you aren't caught in the initial fakeout. We'll see you there.